Good day, students. Today we are going to have a special lecture on International Financial Reporting Standard 1, that is first time adoption of IFRS. But before that, a very important message: दो गज की दूरी, mask जरूरी, stay away from any kind of gathering, don't move out to save yourself from the corona. So this special lecture is emphasized how if one organization which was earlier adopting as generally accepted accounting principles, that is GAAP, but now they wish to switch over to the international financial reporting standard. That means they want to adopt the international financial reporting standards. Then how can they move out? What kind of preparations are needed for adopting the international financial reporting standards for the first time? So the IFRS 1 deals with this kind of a situation. So if any organization has to adopt uh, the international financial reporting standards, then they have to comply with the requirements of the IFRS 1. So as I have already told you that international financial reporting standards, that means it includes international accounting standards, international financial reporting standards, or interpretations of the standard interpretations committee. All those together form the international financial reporting standards. So if any organization which was earlier using as a generally accepted accounting principles, and now if they wish to switch over to the IFRS, then they have to comply with the requirements of the IFRS 1. For example, when you purchase any kind of electronic device from the market, they give you a manual, and in the manual it is written that how to operate that electronic device. Similarly, the international financial reporting standard 1, that is known as IFRS 1, which is very nicely spelled at first time adoption of the IFRS, that is basically a manual which reveals that what kind of preparations are needed from the organization point of view or from a company's point of view in the accounting setup, so that you should be ready for adopting and transition to the IFRS 1. So this is the basic objective of today's lecture. So in today's lecture, our agenda of this session will be, first we will be talking about what is the genesis of the international financial reporting standards. Then we will be talking about the foundation or the introduction of the IFRS 1, what kind of things are dealt in it. And then we will be discussing the main features of the IFRS 1, the objectives of the International Financial Reporting Standard 1, and scope of IFRS 1. Then what kind of procedure of recognition and measurement we will be following while evaluating the various transactions or various assets and liabilities or the items of the financial statements, and what kind of disclosure practices are required as per the IFRS 1 to comply with the requirements of the IFRS 1. So this will be the agenda of this session. So I am preparing this lecture because I have already told you that we will be following the hybrid methodology of teaching, because the time at our disposal is very short, and every student has to work at least 2 to 3 hours for each subject, so that we can put up the gap which is there because of the non-attending of the offline classes. So we would like to make this session more attractive to the students, because when I will be posting this lecture on the YouTube and then you will be listening to it, then in the next online session when we'll be talking to each other, you can have certain queries regarding this beforehand after listening to my this lecture. So this is the agenda of today's lecture. So first and foremost thing which is before us is, what is the genesis of the international financial reporting standards? As I have already told you in the previous lecture, that the basic aim of all these international financial reporting standards is to provide a single set of high quality global accounting standards that require transparency and comparability in information in general purpose financial statements. So whatever the general purpose financial statements are prepared by various companies, various corporations, various organizations, they must be transparent. That means full disclosure of the various requirements of the stakeholders should be there, and the information should be comparable to the other organizations information. That will be possible only when you have a single set of high quality global accounting standards which are followed for preparing such kind of accounting statements or financial statements. So this is the basic purpose. And as far as the IFRS 1 is concerned, International Financial Reporting Standard 1 is concerned, it provides basically a manual for an organization that how they should, when they are adopting for the first time these single set of accounting standards in their organization, because earlier they were preparing their accounts on the basis of generally accepted accounting principles, or they may not have followed the international accounting standards, and they may be following the Indian accounting standard, which may not be having converged format of the international accounting standard. So when they are going to adopt for the first time these kind of standards which are known as IFRS, what kind of preparations are needed, what kind of terminology they have to develop in their accounting system, so that in future we can have such kind of fulfillment of the requirements as per the objectives of these standards. So as far as IFRS 1 is concerned, that is International Financial Reporting Standard 1, this basically deals with the first time adoption of international financial reporting standards. So when you have prepared yourself according to the requirements of the IFRS and moved or transitioned to the international financial reporting standards for adoption, so first time you have to comply with it. First time you have to prepare your organizations, your accounting system, so that your accounting statements now becomes compatible as per the requirements of uh, these IFRSs. So basically the IFRS, as I have already told you, this is a manual. It specifies the procedures for any entity applying IFRS for the first time they must follow in their accounting system or in their organization. So IFRS is basically or essentially a roadmap for the preparers of the first time financial statements under the IFRS. So it provides the users of the financial statements greater transparency by drawing a clear distinction between changes in reported earning arising from the changes in accounting recognition and measurement criteria and the underlying economic activity of the company. For example, when you have to move or transit from generally accepted accounting principles to the international financial reporting standards, there may be certain assets or certain liabilities which were earlier in existence as per the requirements of the GAAP, that is generally accepted accounting principle. But now under the IFRS, these assets may not have been given any kind of recognition. So it means we have to wipe out these assets and liabilities from the financial statements. So accordingly, you have to make certain adjustments in your financial statements, and that may affect your reported earnings from the changes in accounting recognition and measurement criteria. So naturally, it will have some impact on the economic activity of the company. That changes, that recognition and measurement criteria, which has resulted into the certain changes in your earnings or changes in the financial statements in the form of assets and liabilities, that must be disclosed properly. How you have arrived at the various figures, how you have dealt with the assets and liabilities which are not now in existence, how you have dealt with them. So all these underlying things are dealt in the International Financial Reporting Standard 1, which is basically a manual for adoption of the IFRS for the first time. So IFRS 1 also ensure that all first time adopters have a consistent starting point. When they have to adopt, for example, they wish to start preparing the international financial reporting standards as per the requirements of the IFRS, the financial statements from 2021. So it means they have to ensure a starting point also. That means if you are going to prepare your IFRS statement from 2021, then the already prepared financial statements which are prepared for the 1920 has to be converted as per the requirements of the IFRSs, which has already been prepared. Now you have to convert them as per the requirement, so that a comparable financial year information under the IFRS you are going to start from 2021 in the form of 1920 is available with you, so that you can give it to the stakeholders also. So IFRS 1 is gaining popularity because of its all incumbent has to pass IFRS test on conversion to the IFRS. So this is basically a manual which is provided under the IFRS 1, which is known as first time adoption of the international financial reporting standards. So there are certain terms which are used, and you must be familiar with these kind of terms when you are going to start transitioning to the IFRS. So first, the question before us, what is the date of transition of the IFRS? The beginning of the earliest period. For example, if you are going to prepare the financial statements from the 2021 under the IFRS, the beginning of the earliest period, that is the 1920, for which an entry presents full comparative information under the IFRS, is in first financial statement. So date of transition is that. For example, if you are going to prepare the full-fledged IFRS statement from the 2021, then the date of transition will start from 1920, that is the 1st April 1920, which are the statements which has already been prepared under the gap in 1920, that has to be converted as per the requirements of the IFRS 1. And second, the deemed cost. An amount which is used as a surrogate for cost or depreciated cost at a given date, that is the subsequent depreciation or amortization. Assume that the entity had initially recognized the assets or liability at the given date, and that its cost was equal to the deemed cost. Similarly, there will be a concept of fair value, which is very important, and all the total premise of the implementation of the international financial reporting standards is based on the fair value. So basically, this is a new concept, because in generally accepted principles or in generally accepted norms of the accounting, we usually prepare the financial statements or recognize the assets or liabilities on the cost or market value, whichever is less. Or basically, most of the fixed assets are basically put up on the historical basis, historical cost basis. So now this is a transition to the new concept of fair value. So basically, the fair value is the price that would be received to sell or an asset or paid to transfer the liability in orderly transaction between market participants at the measurement date. So every year, the assets and liabilities will be revalued at the fair value, and if there is some increase or decrease, that will be adjusted into the financial statement. Similarly, for example, when you are transitioning to the IFRS for the first time, naturally all your assets and liabilities for the transition period are already stated on the historical cost, and now you have to move to the fair value. So naturally there will be some price differences, some losses or profits may occur, which has to be adjusted in the accounting system, so that we can have the values as per the requirements of the International Financial Reporting Standard 1. Secondly, the most important term which will be encountered many times, because when I started discussion I used it, first IFRS financial statements. The first annual financial statement in which an entity adopts international financial reporting standards by an explicit and unreserved statement of compliance with IFRS. This is very, very important. When you stated explicitly that we are going to adopt the international financial reporting standards, and you issue an unreserved statement of compliance with IFRS. That means it is not there that you will adopt some IFRSs or some IASs. You will prepare your statements accordingly, but you will not use other some. There is no exception to it. If you have to adopt international financial reporting standards, then you have to issue an explicit statement, an unreserved statement of compliance with all kinds of the IFRSs. The first IFRS's reporting period, the latest reporting period covered by an entity, first IFRS financial statement. For example, I have said to you that when you are going to adopt the IFRSs from the 2021, the transition period will be 1920, and the latest reporting period, the first IFRS reporting will be 1920, because you will convert the already prepared financial statements prepared under GAAP as per the requirements of the IFRS in 1920 also. So now the next term will be first time adopter. Who is the first time adopter? An entity that presents its first financial statement under IFRS, that is known as first time adopter, because earlier they were preparing their financial statements as per the requirements of the generally accepted accounting principles. Then what do you mean by, when we are using the term time and again IFRS, whether it is only IFRS 1, 2, 3, 4, 5, 6, 9, or you have certain other things also which are covered under the IFRS. International, when I talked about international financial reporting standards, it means standards and interpretations issued by the International Accounting Standard Board, and they comprise four things. Very importantly, one is international accounting standards, because this term IFRS is of recent origin. Earlier we were having international accounting standards, and they are not replaced with some IFRSs. Some are replaced, but some are still in existence. So all international accounting standards, all international financial reporting standards, all IFRIC accounting interpretations and standard interpretations which are issued by the Standard Interpretation Committee, they are also part of the international financial reporting standards. So when we talk about IFRS, it means IFRS also, international accounting standards also, it includes IFRIC interpretations also, and SIC interpretations also. This is what IFRSs include. So next term which is very important is opening IFRS statement of financial position. So any entity statement of financial position at the date of transition to the IFRS. So if we are going to adopt IFRS from the 2021, the transition period is 1920, and that date of transition to IFRS, whatever financial statement is prepared, that is the entity's statement of opening financial statements. So because earlier we were having the GAAP system, so basis of accounting that a first time adopter used immediately before adopting IFRS, that is known as previous GAAP. So these are the certain terms which I think we must understand in detail before moving towards the requirements of the IFRS1 as per these. So the next is, what are the various main features of the IFRS1? Because I have already said to you that IFRS1 basically applies to the entities that have chosen for the first time to adopt by doing two things. One, by issuing an explicit statement, and by issuing an unreserved statement of compliance with the IFRS. They will not make any reservation that we will adopt this standard and we will not adopt this standard. So when I say that they have to issue an unreserved statement of compliance, it means they are going to adopt each and every IFRS which is mandatory. So in general, the IFRS requires an entity to comply with each IFRS effective at the end of first IFRS reporting period. So if you are going to prepare or converge your financial statements of 1920, then whatever IFRS's, International Accounting Standards, IFRIC interpretations or SIC interpretation at that time are applicable. You have to comply with them all. So in particular, the IFRS require an entity to do the following in the opening IFRS statement of financial position, that it prepare as a starting point for accounting under IFRS. So I would like to tell you that in the regime of IFRS, we don't prepare balance sheet. We prepare the statement of financial position, and that is also in a different manner. We recognize certain assets, we recognize certain liabilities under IFRS, which was not earlier recognized, but we may recognize certain liabilities and assets which were earlier recognized but now not recognized. So these are the differences which we have to find out, and accordingly we prepared all these. So when I said that under the various IFRSs, means IAS, IFRS, IFRIC's interpretation or SIC interpretation, there may be certain assets which were earlier not recognized, or assets or liabilities which were earlier recognized, so not recognized, but now under this new regime they existed. So it means you have to create that asset. So recognize all assets and liabilities whose recognition is required by the IFRS. So there may be certain assets which were earlier recognized but now not recognized. So not recognized items, assets or liabilities, if IFRS do not permit such recognition. So under GAAP, if they existed, then you have to wipe them out. You have to remove from these. But removal, that doesn't mean that you will just put the figure out, but you have to make adjustments in the accounting system. So similarly, there is a need of reclassification of the assets and liabilities that is recognized under previous GAAP, but now one type of asset or liability or component of equity, but are a different type of asset, liability or component under equity under IFRS. So differently, some reclassification is also needed as per the requirements of the IAS1. So accordingly we will make. So apply IFRSs in measuring all recognized assets and liabilities, because all kind of assets are dealt by different IAS, that means IAS 1 to 41. So similarly, some IFRSs are there which deals with some certain kind of reporting practices. We have to comply with all these while recognizing, and first recognizing, then measuring, and then disclosing the information regarding such kind of IFRS. So the IFRS grant limited exceptions from these requirements in specified area where the cost of complying with them would be likely to exceed the benefits to users of the financial statement. So when we are going to adopt the IFRS for the first time, the IFRS's provisions, the various provisions of the various IAS, they give you certain kind of exceptions that you may not comply with these, because the basic purpose is that when you are going to converge your financial statement as per the new regime of IFRS, that means that must be beneficial to us. If the cost of convergence is going to exceed the benefit, then there is no benefit of converting the financial statement as per the IFRS. So this IFRS1 give you certain kind of exceptions from these requirements in certain areas. In later part of our discussions, we will be talking about that. So the IFRS also prohibit retrospective application of the IFRS in some areas, particularly where retrospective application would require judgments by management about the past conditions after the outcome of a particular transaction is already known. So wherever judgmental things are there, that prohibit the retrospective application of the IFRS. So this is one of the main feature of this. So similarly, the IFRS require disclosure that explain now the transition from the previous GAAP to the IFRS affected the entity's reported financial position and financial performance and the cash flow. So this will require that when you transit from the earlier GAAP to the IFRS, and you are making certain changes in the structure of your assets and liabilities, structure of your income and expenditure, structure of certain disclosure practices, naturally some revaluations, some post valuations will be done on the basis of the requirements of the various IFRSs. there will be needing a need of disclosure, that how, and that is the needed how such transactions move to that, toward that, and how these calculations are made, and how it is going to affect the financial position, financial performance, as well as the cash flows. So similarly, the entity is required to apply the IFRS if its first financial statements are for the period of beginning on or after 1st July 2009. Earlier application is encouraged. So similarly, for example, let's take an example. Suppose XYZ Limited decided to adopt IFRS for the financial year 2011-12. That is April 1, 2011 to 31st March 2012. Now they will be preparing their financial statements as per the requirements of the IFRS. They have issued the explicit and unreserved statement of the compliance. So now there will be four things which needs to be understood. First, the first year of reporting. Second, what is the date of adoption? Then date of reporting, then comparative year and date of transition. These four things needs to be explained. Now the first year of reporting. So first year of reporting will be accounting period commencing on or after April 1, 2011, because we have decided to start it from 2011-12. The first year of reporting will be April 1, 2011. Second is date of adoption, naturally 1st April 2011. Now date of reporting, that is the last date of the first financial year, that is 31st March 2012. Now comparative year is there. Comparative year is year preceding year of the first year of reporting. That is, if we are going to adopt it 2011-12, then the reporting year previous to that, that is 2010-11, that is 1st April 2010 to 31st March 2011 will be the reporting period. So it means if you are going to adopt the financial statements to be prepared under the IFRS from 2011-12, the first year of reporting will be 1st April 2011 to 31st March 2012. The date of adoption will be 1st April 2011. The date of reporting will be 31st March 2012. The comparative year will be preceding 1 year, that is 2010-11, and the date of transition will be 1st April 2010. This is very much important to understand if you have to understand the provisions of the IFRS 1. So here date of transaction, reporting date, comparative period, and has been shown in the form of a chart. So April 1, 2010 is a starting period of comparative period. First IFRS financial statements will be from 1st April to 31st March 2012. Next, before us is what are the objectives of the IFRS 1? As I have already told you, that the main object, basically IFRS 1 is a manual which provides you the guidelines how to transit from the generally accepted accounting principles towards the main IFRSs. So the objective of IFRS 1 is to ensure that an entity's first financial statement under IFRS and interim financial reports for the period covered by those financial statements contain high quality information. Secondly, to ensure it is transparent for the users and comparable over all period presented, it provides a suitable starting point for accounting under IFRS and can be generated at a cost that should not exceed the benefits to the users. So that's why it provides certain kind of exceptions to it. Next is the scope of IFRS 1. Where there's a limit to adopt it. Basically, the IFRS 1 is only applicable for the first time users. Its first financial statements are prepared as per the requirements of the IFRS 1. After that, when you started using it, you have issued explicit and unreserved statement for compliance of all the IS, then in future there will be no need of it. So each interim financial report, if any, that it presents in accordance with the IS 34, that is the interim financial report for the part of the period covered by the first IFRS financial statements, that we have to follow. This is a scope. So the careful analysis of these specific facts circumstances as enshrined in the scope of IFRS 1 laid down the following key concepts that we must follow. First, identify the first IFRS financial statements. Secondly, prepare the opening statement of financial position at the date of transition. For example, if you are going to adopt it from 2011-12, the reporting period previous to that, that is the date of transaction, is 1st April 10 to 31st March 2011. So select the accounting policies that comply and apply those policies retrospectively, not prospectively, to all these periods presented in the first IFRS, because when you are going to use it from 2011-12, then naturally in the 2010-11 also you have to adopt the same accounting policies and comply with that. So the comparable period information is available with all of us. So consider whether to apply one or any of the exemptions from the retrospective application. There are certain exemptions which are given in various IASs. So apply the mandatory exception from the retrospective application. Make effective disclosure to explain the transition to the IFRS. And the most important IFRS 1 is that aspect of the IFRS 1 is that entity must adopt IFRS by explicit and unreserved statement of compliance with the IFRS. So it is not there you will adopt it in part or may not adopt it one. So under the IFRS, now I am just going to tell you, there's a total change in the structure of the financial statements. Earlier we were preparing trading account, profit and loss account, balance sheet. Now there are different kinds of, and cash flow, fund flow were not part of the financial statement. They were just for interpretation. But under the IFRS, the IAS1 defines a complete set of financial statements to be comprised of the following. So we have to prepare the 6 statements. Number 1, a statement of financial position at the end of the year, which was earlier known as balance sheet. Second, we will be preparing a statement of comprehensive income for the period. Earlier, we were preparing trading, profit and loss account. So now we will be preparing a statement of comprehensive income for the period. Then the statement which we were earlier not preparing, that is a statement of changes in equity for the period. Because this is very important. How the equity, the shareholders' money has been changed over the period of time because of the transactions. This statement will be telling that. Then statement of cash flows for the period, which was earlier not part of the financial statement. Now it is a part of this. Then notes comprising summary of these significant accounting policies and other explanatory information which is there. And similarly, we'll be having a statement of financial position as at the beginning of the earliest comparative period, when an entity apply accounting policy retrospectively or makes a retrospective statement of item in its financial statements, or when it reclassify items in the financial statement. So these are the basically 6 statements which are prepared when we adopt it for the first time. After that, 5 statements will be prepared. That is a statement of financial position, statement of comprehensive income, statement of changes in equity, and statement of cash flows, and the notes comprising the summary of the significant accounting policies and other explanatory information. So this will be the components of the financial statement and the restructure of the financial statement, which you have not earlier studied in your graduation level or at +1, +2 level. So this is a new change which has been there because of the changes. So under IFRS, it has given certain kind of guidelines regarding the recognition and measurement of the assets and liabilities. An opening IFRS statement of financial position will include this recognition and measurement criteria, accounting policies, as far as paragraph 7 of the text of IFRS1 that state that entity shall use the same accounting policies in the opening IFRS statement of financial position and throughout all periods in its first IFRS financial statement. So this is needs to be disclosed, and similarly it requires the comprehensive comparative information also, because we have to, if we are going to adopt it for the first time, then you have to give the comparative information for the transition period also. So it emphasizes on comparative information. So entity's first financial statement comprise at least 3 statements of financial position, 2 statements of comprehensive income, 2 separate income statements, 2 statements of cash flows, and 2 statements of changes in equities and related notes, including at least 1 year of comparative information prepared under the IFRS. So this is one format of the statement of financial position which I am laying before you, which we'll be discussing in later part also in different lectures. So these are the certain kind of assets, and in assets only these assets will be recognized. All other assets, if existed in the balance sheet of earlier gap, that will be removed and adjusted accordingly. So it will be termed as non-current assets. That is, they will be covering property, plant, and equipment. Then we will be having goodwill, other intangible assets, investment in associates, and investment in equity investment. Similarly, we will be having current assets, which include inventories, trade receivables, other current assets, cash and cash equivalents. So similarly, from the liabilities point of view, equity and liabilities, equity attributable to the owners of the parent, similarly non-controlling interest, total equity, non-current liabilities, non-current current liabilities, all will be explained, and then total liabilities and total equity and liabilities will be shown. So this is a structure of the statement of financial position as per the norms of the this particular IFRS1, which has been prescribed under this. So we have to follow all these requirements when you prepare the financial statements under the IFRS1. So again, I'm telling you that IFRS1 is basically a manual which provides you the various rules and regulation which prescribe you the different methodology, that how you have to transit from the earlier gap to the IFRS1. This is basically a manual which gives you the guidelines, but reading of the text of the IFRS is very important if you want to prepare for the first time the financial statements under IFRS. So thank you very much. In future also we'll be meeting through this YouTube channel and prescribing you the various things, so that because we have to follow the hybrid system of teaching, and I expect from the same kind of labor which we are putting in. So again, in the end, I will request to all of you, please stay home, stay safe, don't move out. Wherever 3 or 4 people are standing, please don't mingle with them, don't stay with them, because you have to save yourself, you have to save your family. You have to दो एक मंत्र जरूर याद रख लो कि जब तक दवाई नहीं तब तक कोई ढलाई नहीं. एंड सिमिलरली मास्क जरूरी, एंड सैकेंडली 2 गज की दूरी, ये जरूर ध्यान रखो. मेरी ਤੁਹਾਨੂੰ ਸਾਰਿਆਂ ਨੂੰ ਹੰਬਲ ਰਿਕੁਐਸਟ ਹੈ. ਅਸੀਂ ਆਨਲਾਈਨ ਬਹੁਤ ਮਿਹਨਤ ਕਰਾਂਗੇ, and we will be striving to achieve excellence through these online teaching also. So thank you very much. Thanks to all.